Hi, I'm Steve Van Metre. We're live. I'm laughing because I goofed the first one up and had to start over again. But hey, that happens sometimes when you're doing this stuff live. Anyways, thank you for joining us for our weekly economic update as always. And I'm really kind of just stuck today on the fact that everyone's so excited about the economy because they're watching the stock market again, and the economic data is terrible. And they're all saying, oh, it's due to the shutdown. It's due to the government shutdown. Well, the reality is, if you look at the data, the government didn't shut down until the end of December for the most part. And yet the December data was bad. So was the entire economy like, oh my God, the government's going to shut down, so I'm not going to spend? No, I don't think so. What you're seeing is the tax cut is fading and the monetary lags are starting to catch up to this thing. And the data is, well, not good. And just for example, and we're going to go look at some of this data a little bit tighter or a little bit closer here, is auto sales in the United States. I mean, literally across the brand, down in January. And the data today for February, down in February. So if this is all government shutdown related, how did it start in early December and flow this long? I mean, most of the people got paychecks into, say, mid-January. So why would they quit spending in early December? I don't get it. But whatever is happening beyond that, what we're seeing is a global economy slowing. We're seeing all the Fed tightening starting to catch up. And let's take a look. I've got this pretty cool post that I found on Zero Hedge. And the guy posted 18 reasons why the U.S. economy is starting to fall. Farm loan delinquencies just hit the highest level in 9 years. We just learned that U.S. exports declined by $4 billion in month December. JCPenney's closing 24 stores. Victoria's Secret's 53 stores. Gap closing 230 stores in the next 2 years. Payless, all stores. Tesla, who's got a lot of problems on their own, closing all their sales locations. Pepsi Company is going to lay off workers and give them a severance. The Baltic Dry Index, which tracks the shipping prices, that's at the lowest level in more than 2 years. So going back to 2016 when we almost had a recession. We've had the worst drop in factory orders in 3 years. The largest decline in the Philly Fed Index in more than 7 years. Existing home sales dropped 8.9% from a year earlier. That's third month in a row and terrible. Housing starts are down 11% in December. You can't tell me that was due to the government shutdown. Compared to a year earlier, home sales in California were down 17% in January. Home sales in Sacramento County were down 22% compared to a year earlier. That's huge. Pending home sales in the United States have now fallen on a year-over-year basis 13 months in a row. And remember, housing generates a lot of money into the economy. More than $166 billion of student loan is now seriously delinquent. Unfortunately, that's a lot of millennials. And more than 7 million Americans are 90 days delinquent on their auto loans, which is 1 million more than it was at the peak during the last recession. And so you kind of look at this and say, why is everyone so excited? Well, a lot of people think that the economy is magically rebounding or the Fed's going to save the day. We've discussed this earlier this week when I kind of talked about the Fed testimony, Jerome Powell's, the Fed chair in front of Congress. And the reality is the Fed's just following their inflation data and tightening monetary policy. And this is what happens when you artificially lower interest rates for a really long time and then you start to raise them. And all of a sudden, people stop spending and can't pay their bills. And it comes back to this simple logic. I remember when the first iPhone came out, it was like $400. And while I've only ever owned one, the original one, I understand that the new ones are about $1,200. It's a threefold increase in price. And last I checked, not very many people had a threefold increase in income over the last 10 years. And that's why this doesn't work. If wages don't rise to meet higher asset prices, this system eventually crumbles when the Fed tightens. We've seen this story over and over and over again, but just like in the past, people don't believe it, and I don't know why. So in this week's update, I kind of mentioned that the cycle is rolling over, and we're seeing it all over the place, not just domestically, we're seeing it overseas, especially coming out of South Korean exports, which are way down. And we know, because we've seen the data, and I don't have a chart on it, so I can't really show it a current one. But anyways, we noticed that the global economy follows them down because South Korea is a massive export nation. And we should see, S&P 500 companies' earnings per share data drop. And you start to wonder then, why are U.S. CEOs quitting their job faster than they did at the peak of the last recession? And why are they cashing out more of their stock than they ever have as fast as they can? Because they know the data is going to look ugly and the market is going to adjust. Now, what is really weird about this market that baffles not only me, but a lot of people is this last cycle up has been all on selling, or up, I guess. No, there. I gotta get a mirror for myself so it's working. So last cycle up was all on selling. All these things called fund flows all showed money going out. And yet the market is up because what we have is this bizarre computer-controlled market now. I mean, it's virtually entirely controlled by computers. And they put these artificial bids out on the market, whether there's a buyer for it or not, they just post it out there. So it looks like the market has buyers. So these prices hold, and then these corporations come in, they can buy up to a quarter of their daily trading volume back in stock. So they're just buying incrementally higher because these computer algorithms are driving it up. And it's going to be a very interesting day when these computer algorithms do not support the market anymore. Because when we see these companies miss earnings and their stock drops 20% in a minute, how can that not happen to the broad market? I think it can. And that really concerns me that at some point we're going to see that day. And that's going to be the day that the Fed and the Securities and Exchange Commission get dragged in front of Congress and start answering questions while we turn the entire stock market over to some untested computer programs. But that's not the only case that's going on. There's someone called the CME Group, and they handle the futures trading. And what's interesting is earlier this week, mysteriously, the futures exchange shut down for a while because there was a problem with the computer program, and they didn't say what it was. All of it was like people say, hey, there's a bunch of sell orders coming in. Oh, market shut down. It wasn't a trigger. It just, there's something wrong with the code. And people that understand this and watch the trades, because they have the ability to, have noticed that when buy orders on the futures exchange come in, they're allowed to come in. When sell orders come in, they're being throttled and being held up until a matching buy order comes in. So the futures exchange is literally trying to prop the market up. And yet, before long, we're going to be in first quarter earnings, and they're not going to be good. So let's get this disclosure out of the way. The content of this video is provided as educational information only, is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or participate in particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that one do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So I want to look at some charts, and I got some websites and stuff we can look at, and then we'll get into the charts because there's finally something's going on with gold that I thought was going to happen, and then emerging markets hit my radar today, and it was kind of in the back burner, but moving to the front, and I want to show you. It's pretty cool. So listen to charts and see what we've got going on here. The money supply, as I said, would roll over. It is rolling over. The year-over-year growth rate is down to 4.21%. Remember, this has been dropping now about 0.2% per week, and that'll put us back in a few weeks right in line with the danger zone. We'll turn this back to red. And not that 4.2 is just not slow enough to cover all the debt. I mean, that is not what it needs to be. The 6-month rate of change took a big drop. The 3-month rate of change also fell. So these things are saying the year-over-year growth rate is headed lower, and the growth rate decreased by 27 billion to 583 billion this week. Looking at commercial industrial loans, which I've been saying for a while, it's going to start rolling over. Well, it looks like it started rolling over today, dropped down from 11 some odd percent to 10.6. And I said, as the back end number rises, which it did about 0.4%, it should start to roll this thing over. And we'll talk more about this in a little bit. Credit card loans roughly flat, around 5.54% year over year. No major growth here, but still interesting that consumers not rebounding with the market. Well, that's what we should see. So that's very interesting there as well. The Federal Reserve balance sheet fell by $7 billion. So again, no bailout of the markets here. This thing continues to fall, despite all the jawboning by the Fed and the financial community that the Fed is going to stop. Well, if you see stoppage here, you please email me because I don't see it. While the savings rate increased last month, we certainly didn't see it in bank deposit growth rate, which is an anemic 1.5% year over year. Again, just showing the consumer is just not in a good place right now. And as far as retail sales go, this is really interesting. This is First Data Merchant data. I think we may have looked at this earlier this week, but it's worth looking at again. This was posted on Twitter by Teddy Vallee, and who's First Data Merchant Services. They handle a lot of retail sales credit cards, and here you can see that in the first couple months, this is going back now to December, January, February, and what they're saying is consumers aren't spending money at retailers, and that means all the retail sales data that everyone's blaming on the shutdown is real. Looking further, we see housing starts starting to break down their uptrend line. And when you break an uptrend line, well, that usually says bad things are coming. And we see that in the housing start data here. And looking at the City Economic Surprise Index, this is a surprise index as economists say, hey, I think this is a number, this is what's going to happen. And when they're right, it goes up. When they're wrong, so when the data, when they say, I think inflation is going to be 1.3 and it turns out to be 1, not only does it factor that they were wrong, but it factors by how much. And the surprise index has been going down while volatility has inverted, has been low, and what this is saying is volatility should be headed lower, and we're just seeing what I'm going to refer to as a dislocated market. And then David Rosenberg posted this on Twitter today. This is really cool. The real world monetary base. So this is looking at all of the bank excess reserves and money in circulation around the world on a year-over-year percentage change. And when it gets into low levels, it's usually where you start to get into concerns of a recession. So you can see right before all these recessions, you had a very low monetary base. At least it wasn't growing. Well, look, we should have had a recession here. You can see on a year-over-year basis, the global monetary base was just really low, and here's decelerating again. And well, I know a lot of people think, it's not going to happen this time. Okay, well, I hope that you're right. So let's chat a little bit about what's going on with the banks, and let's take a look because the Treasury yields we saw rise this week. I don't think that's a big issue, although commentary was that nobody really had an answer for why it was rising, and I kind of agree with that. I didn't see anything. But looking at the bank holdings, this would be a week ending of last Friday. They dropped mere $2 billion of Treasuries. They increased $2 billion of mortgage-backed securities and dropped $4 billion of non-mortgage-backed securities. So here we can see the banks really aren't dumping Treasuries. Now, maybe they are this week, but last week they certainly didn't. Looking at margin debt, I find this interesting. This drop in margin debt was a 20% correction in the market. You can see it's gone up a little bit. But remember, back here at the dot-com bubble, this collapse in margin debt was an 80% drop in the market, and we're still way up here. So that's pretty dangerous. So when I look at, I've been looking at world dollar liquidity, and unfortunately the fourth quarter data is not out. This is a sum of the monetary base plus federal debt held by foreign and international investors. So this should be out any day. I mean, when I look back at when it comes out, it should be out today, but it's not. And you can see it's pretty much flat, and it may be contracting a little bit, but we'll see in the fourth quarter. So we'll just say that this is a non-issue in the factor here. So when I go to the monetary base and set it on a year-over-year basis to see where the world dollar liquidity is headed, and it's going to breach the 2000 low, which is the lowest point in history the world where world dollar liquidity was, we can see right now, just based on the monetary base, we're back where we were in 2016 when we were on the edge of recession, and we're lower, at least from the monetary base, than we ever have in history. So this is very concerning to me on what I think is coming in terms of a very nasty global recession. And of course, we have an issue where central bankers just don't have the policy tools to save us. And even if the Fed tried to today, due to these long lags, they've been tightening for 3 years, and the economy, starting to digest those now. The people that didn't buy homes, a year ago and didn't buy cars, this is all starting to show up now. It's not good. So I'm getting really interested, as you know, in gold, and there's some cool things that are happening in gold right now, and I want to show you that in a moment. But emerging markets hit my radar, and when I look at emerging market stocks, I notice they seem to be fairly correlated with the monetary base, which the Fed is contracting right now. But they're also inversely correlated to the dollar. And so here's where we get into the question of where's the dollar going. Long-term macro economists or even macro traders who really know their stuff say the dollar is a flight to safety. So in recessions, money goes into the dollar and U.S. Treasuries, which is why you see the dollar and U.S. Treasury bonds rally at the same time. Okay, I see that. The other thing, and I've showed this in the past and I didn't have time today, that's why I'm live because I was running out of time, is I think the dollar is actually more correlated to commercial industrial lending. And when I looked at that, I noticed that large corporations tend to borrow going into some recessions, and that's why you get this overshoot of the dollar, whereas you don't always get it. So let's take a look at a live chart of commercial industrial lending on a year-over-year basis. And we've got this thing maxed out, and we're starting to roll over here, and that kind of signals perhaps a peak in the dollar. But look at the last recession. It overshot, and it kind of, corporations were borrowing into the last recession. This one here, they didn't. This one here, they didn't. This recession, they did, and this one. So when I hear these people say, well, yeah, the dollar tends to rally, it doesn't rally in every one of them. Currencies are very difficult to understand their movements and whatnot. So I actually think there's a really interesting setup, and the emerging market stocks are telling us something interesting is happening. Kim, thanks for joining us. Ray, glad you could be here. Let's jump over to some charts and see. In fact, since we've just been talking about emerging markets, let's just cut to the chase and let me show you what I see there, because this plays well into the gold thesis of what's going on. So here we see the emerging markets, and let me zoom out a little bit. So the last major bottom here, we have a left shoulder, a head, and a right shoulder. And you can see the 100-day moving average curled up. The 50-day was rising. Stock prices broke through the 50-day, which is where you start to think that a rally's beginning, broke through the 100-day. And look, it came back down and reconnected and then took off. So let's fast forward to here. We have one bottom, two bottoms. So we have a double bottom, which is a very clean signal in technical analysis. It broke through what would be the neckline, which would be where I've got this purple line right here. And it came up and starting to roll over a bit. Now, if we look between the two, what we see here is the 100-day is kind of flattening out and starting to curve up. The 50-day in green is rolling up, and the 200-day is trending down. Let's look at what we had here. We had the 100-day when it crossed trending down and flattening, the 50-day rising, and the 200-day falling. So we see very similar in terms of the moving average. So what should we see as a buying signal? Well, what you want to look and see is volume. Do we see a lot of volume on the sell side? Yes, we see it right here, so that's validating. And then what happened over here? It came back down, hit the 100-day, but notice right in this volume here, see this little spike? This was people selling out. So what we want to see here, we see low volume here at the peak. We see this coming down, and this could be a really great buying opportunity right here, because if this sticks, you've got a shot that this thing's going to at least get up into the $46 range from 40. And it's pretty interesting to me, because if emerging markets are signaling what they're signaling here, they're telling us that these big investors think the dollar is headed lower. Now, if you know that, you also know that, one, that could be bullish for oil. And I'm going to tell you when we look at oil, that's not going to be the case this time, but it is bullish for the gold. Makes this really, really interesting. All right, so that's what's gotten my attention on emerging markets. I've got this flag, this purple line. I'm going to be monitoring this. If this thing firms up, I mean, we might see this trend down and the 100-day start to just tick up, and we might see some confluence right in here. But you'll notice the last time it happened, it bottomed again. I'm not going to suggest it double bottoms the second here, but it gives you a nice, clean signal of what to look for. Sure, can you try to trade these drops? You can. But the best thing to do is let this thing settle. So why would it settle is the big players are buying in down as this bottoms. Then they're selling into this rally, buying some more here, letting it come up, and then they're going to flush out the weak hands. And that's why you're going to want to see it settle somewhere right in here, because that's where they've been buying. They've been buying all of these dips where you see the spike in volume. So that's what we want to see. And I think that's pretty compelling. All right, so let's go to the S&P 500, which is pretty much where it's been since January of last year. So it hasn't really gone anywhere. And every time it gets into this white channel of 2816 to 2790, it gets rejected. And this is the longest time it's spent there. Now, it went over it back in January of 18 and came back down. But just in terms of being in the channel, it spent the whole week here, which is pretty unusual. The sellers didn't come in. But what's kind of unusual is, again, as I mentioned earlier, we're seeing retail buying. I mean, retail sold, and now they're appearing to come back. They always buy high. Remember that. So assuming this doesn't stick because the Fed is still tightening and there's really no basis from the economic data to say that this was a valid move up, other than the fact that corporations had to double the rate of their share buybacks to get this somewhere. And the volume is also telling us, see how low the volume is? There's not any big players coming in at this level at all. So this is, anytime you see a rise on falling volume, eventually it comes back down, and there's no doubt we're going to see that again here. So that's the story on the S&P. I think this is going to eventually retest as 2350, and my guess is it's going to go through, because if it was going to stick, then you would see CEOs buying, not selling. All right, so 10-year Treasury yields. Let's zoom out a little bit just for fun. They couldn't break through this support level. They tried and tried and tried and tried, and I thought, they were. And today they went up. Now, as we've talked about, and I will put this on here again, is if either stocks come down or yields have to go up. And you can see they kind of follow each other. So stocks have not been able to pull down. Now, we know oil hasn't rebounded with stocks either. And since oil has been tracking the market as well, except for now, and yields have been tracking the market except for now, this still is not a positive sign for stocks, but it tells us that yields had to come up a little bit. Is this the end of the world? No, because the banks are still holding a boatload of these things. And with the economy slowing down, they're not getting rid of them anytime soon. So this is not really an issue. But we could see that the 30-year yields came up and tagged their 200-day moving average here, where there's been support, at least in the past. So we can look back and see there's lots of support right in here. So is this a major cause for concern? No. Is this a major cause for concern on the 10-year yields? No, because we've got resistance right here and we've got resistance right here. So maybe the Treasury bears just thought, hey, if you didn't break down, we're going to give it another swipe. And I think that is pretty much what we're seeing now. But the economic data is not validating higher rates. I mean, it's just, there's nowhere in this big picture are you seeing people saying, gosh, I'm glad interest rates are going up. I mean, when you see car sales fall 2 months in a row, you see home sales falling, you see retail sales falling. What is it telling you? The monetary system's too tight. There's not enough money. But speculators are still convinced somehow interest rates are going higher. So they're going to keep trying. But they're going to end up losing along the way. So at some point. So let's go and we'll take a quick look at oil and gas producers. And here you can see they're not confirming this. In fact, if we overlay them, let's do that. And we'll see. Here's oil and gas producers. We'll even zoom it in a little bit so we can cut out that little bit there. Not confirming. I mean, if the economy was booming, wouldn't people be buying a lot of gas and oil and stuff? Yes, of course they would. I mean, it's logical. But all my sources, and I got sources all the way high, all the way low, and everywhere in between, and everybody's telling me supply is way higher than anyone knows. There is a supply issue. The demand isn't there. And you're starting to hear, the Saudis are cutting production. Look, I make a phone call to my people who have worked in this business for decades, and here's what they tell me: you can't turn oil off in a day. When you get the call to start turning off, this thing takes months. There are lags, so there's still going to be an overflow of supply that's just not showing quite up in all the data. I mean, we saw a big build the week before. We saw a big draw this week. But in the end of the day, when you have lower car sales, lower home sales, lower consumer spending, lower South Korean exports, you don't need much oil. That's why oil is going to tell us where the stock market is headed. And so we've got this rally in stocks that is just not confirmed by anything. And so we'll remove that and go back and look at the oil and gas producers. So from a bullish perspective, this zone right here is support. It's found support here. The 50-day moving average is rolling up. It's finding resistance right in this band here. But again, I still think we've got a test of these lows that it's going to break through, because when the data comes out for the first quarter, or we continue to see the excuses of government shutdown, I don't know how long the market can continue with that. It's just not going to validate the rise in stocks. So let's look at gold. This is interesting. And we'll leave it right here for a moment. All right, so what? I've gotten some calls. Yeah, I thought you were going to buy the gold miners. I see it's going up. Why didn't you buy? I'll give you 3 reasons why, other than all the other reasons that I give you, because I know who's been buying. 1, speculators who get in and get out at a moment's notice. 2, hedge fund managers who we haven't really seen all the data, but we've got some of it now. And 3, the CTA quant computer programs have been buying. There's your 3 buyers. Okay? Now, where's the big players? You'll notice I did not any of those 3. And all of those 3 combined could not break the market to new highs. So let's take a look at gold, and it didn't even get over 340. It needed to get over 380 to really cause some pandemonium. 1400 would be the final line in the sand for anyone who missed it. But what happened? It rolled over. Now, I've been saying this was going to happen because when these speculators realize it's not going higher, they'll start to run, hedge fund managers will start to run, and then the quant computers will start to sell. And so what this tells us is we broke support here, so we should now be headed somewhere down in this area. Now there's some support here in this 1280-ish area, but the major support is between 1230 and 1250, and there's a boatload of moving averages in here. Moving averages do act as support, so I like this move down because what it's going to tell me is where the big guys are at. I don't want to buy in after the computer models and hedge funds and speculators. I want to get in before them. But when you see those 3 rush in, the big players know, and so they're going to say, you're not getting ahead of us. We're going to slam you back down. And when those players exit, that's where you find where the big money is at. And we know this looks good because when we look at this from a chart price perspective only, now momentum has told us this is a valid move. The momentum is turning up. We know that. But look at all the support here. If this is where the big players are at, then the price dropping into the 1240s is not a big deal. It could even get down to 1200. And if it finds support here, it's telling us this is where the big boys are at. That's what we want to know. And then we can kind of, at that point, make a move in, knowing that these people aren't selling. That's what you want to see. So let's look at the gold miners. As expected, they're following suit. They could not get out of their trend either. So this is kind of been a hard line in the sand for the gold miners, this green line. I knew it wasn't going to break through on this. It's got to come back down, and starting to. So where does it go? Well, its first destination is going to be around here, 21.25, between that and 21.50. There's a gap here, and why markets have been cleaning gaps up so well, probably the computer program. The next step is here. The final step would be down in here. So I'm suspecting the big players are going to start putting a floor somewhere in here or down here. And we'll know that because that will validate all of this down here. You've got the daily moving average, the 50-day, 200-day, 100-day sitting here. From the weekly moving average, you've got them all over the place right here to the 100-day or 100-week to 200-week, 50-week. And then you've got the monthlies sitting right, the 50-month right under here too. So you've got all these moving average support. All we need to see is where the big players are, because all these other people will run. Hedge fund managers will run when things go down. Speculators will run when things go down. And computer models will sell last because, well, that's how the computer models work. They're lagged. They've been getting trashed in this deal. So it's kind of interesting to see where support's going to really be. But I like this because this is where we'll know where the big players are in. That's why I didn't jump in, because I had a hunch that this move wasn't the big players, and it's not. So now we know, and that is going to help us make a low risk entry point. Again, and looking at silver, who was not confirming the move in gold, it came down into its support zone, broke through its 50-day moving average and its 100-day moving average. So it's got some room to come down on those two, and that's kind of been my benchmark for what's going on. But due to thin trading volume, I mean, these things are only trading 109,000 shares. We really, unfortunately, can't play in that space at all. Let's take a look at the 7 to 10 year Treasury bonds. Would have loved to see this hold here. Support is somewhere right down in, and I moved these lines because I thought we were done with them, but support's going to be right down in here. Does that mean yields are going to go all the way down there? I don't think so. There's going to be some support right in here. Look at the long bond. We see it broke through support, but it's got some moving averages sitting under here, and it's got some heavy support. So this is clearly speculators really slamming this thing down, because what speculators believe is they now believe that there's going to be a massive reflation. And I don't know where they're getting this notion from, because Jerome Powell pretty much squelched any notion that he's going to underwrite the deficits. He said that's not going to happen. And they're still tightening with their monthly balance sheet unwind. And there's probably not going to be another rate hike. So I don't get it. Again, these people are all on the wrong side of the fence, and they will eventually find that out. The last thing I want to take a quick look at is the ags. And I have no clue why these keep getting beat up, because if there was a trade deal, they should be rising. But even if there's not a trade deal, with farm foreclosures just escalating, and this was echoed in the Senate testimony when they were hammering Jerome Powell. They said, look, these farmers are foreclosing, you need lower interest rates. And no, but today's reversal was very strong. I mean, it dipped, and then all of a sudden, bam, out of nowhere, this drove prices back up. So that's a pretty positive sign for that sector there. So kind of with that, I think I'm going to hit I'm a little over my normal 30-minute mark. So we'll probably be back Monday. Hopefully there'll be some interesting stuff to look at. But right now we see the market just stuck in this sell zone, and the big players probably have a little more to sell, and that's why they're letting people come back in and sell, and there's not a lot of volume, so we're not seeing a big thrust of buyers. And that makes this challenging for the big players who have been consistently selling at that 2,800 mark since January. So kind of be interesting how this plays out. But with the global economic data headed lower, and world dollar liquidity headed lower, and the money supply at an anemic rate in the fourth quintile, which is recessionary on its own, we know where stock prices are headed. And that's okay, because that should be potentially really good for gold. And now we'll throw emerging markets onto that list too. So maybe we'll pick up some of both. I think if the dollar does roll over with commercial industrial lending, which of course we're going to watch every week, then we know we're all over it. All right, I'm Steve Van Metre. Hope you have a great weekend. If you have questions, give me a call, send me an email. I'm here for you. Bye now.